welcome everyone. This is a bit of a reprise of a presentation I gave not that long ago. We're going to update it in a couple respects, but I can't stress strongly enough that what I've called the new FAANGs, and this of course was a term that first came from a Merrill Lynch analyst earlier this year. This is going to be the investment theme for the coming years. Now, as why am I not advancing this here? Bear with me, I apologize. There we go. Hit the right button. Okay. As we get into this, I'm going to cover a lot of different subjects. We're going to go through this as quickly as possible so that we can save some time at the end. As Dylan said, whatever questions we don't get to that have been sent in, they will be answered by me separately following this as I have some time. So don't hesitate to ask questions. You can drop me a line as well if you want a copy of the slideshow. Now, of course, right now, the problem that we have with any investment theme, pretty much no matter what it is, unless you're long the US dollar, is the Fed has really made a mess of things in the recent past. We had Jerome Powell, the Fed chairman, who all of last year was a serial arsonist. I think by now we can safely say he outdid everyone from Arthur Burns to Alan Greenspan. With creating massive asset bubbles, now the highest inflation in 40 years. So we've gone from the arsonist to now Fire Marshal J. If you remember, of course, Fire Marshal Bill, the iconic Jim Carrey character from In Living Color, Powell is trying to do that. The problem is he's trying to put out inflation. He's going to take a lot else with it. We've seen the dollar screaming higher, and it's caused problems the world over. We've had a bankruptcy of an entire nation, Sri Lanka recently. We've got others teetering on the edge. We've got zillions of dollars of external debts of developing nations that are unpayable. Last but not least, China continues to teeter on the edge of a much larger implosion. Another real estate company went bust there recently. There have been bank runs. People can't get their money out. Not a good situation. And all of these things, as well as stock and commodity and other risk asset markets, have all been roiled by the Fed belatedly trying to undo at least some of the damage that it did. The question is, as I'll close with in a few minutes, how far they go and whether we see an end to this inflation fighting come about the easy way or the hard way. Now, as a consequence, the old FAANGs, as well as a lot of other stocks out there, as you've all felt to one extent or another, I'm sure, have been under a lot of pressure in the recent past. Here you see the old FAANGs that are all well off of their running 52-week highs. As a group, their losses have pretty much doubled or slightly more, the S&P 500. The question is going forward, because we will get to a point where the Fed stops its rate hikes by choice or by their own accident. We will get to a point where we have new growth come from different aspects of the economy. And the question is, where is that going to come from? And I'm a firm believer in this new FAANGs or FAANG 2.0 theme that Merrill Lynch coined that term earlier this year. Well, a lot of us have been talking about these sectors individually for a very long time. We have still a growing global population, still an insatiable demand for the better things in life, for new technologies, and most of all for energy. So all of these different new FAANGs, and we'll run through them here quickly, are going to play a major role. A lot of them, even notwithstanding the recent corrections that some of these sectors have taken, have still done far better than the market, mostly in old energy and in the uranium and nuclear energy space. Gold even has held up in relative terms better than the broad stock market. And we're going to touch on all of these as we go through here. But with all of these different things, folks, all of these different commodities and themes and substances, we've got a lot of commonalities. We've had years of underdevelopment and investment, scarcity, even to the point of crisis in a lot of things. That has, of course, been augmented by a lot of policy errors, by this proxy war against Russia, and by the world starting to feel, and again, this proxy war with Russia has accelerated a lot of these things, that they're just tired of the US-centric, US-dominant regimen that we've had since the end of the Second World War. So it's causing a lot of fissures to open up in what had been a more static globalization regimen for years. And even before the last couple of years, there were already moves on the part of many countries, many industries away from this. A lot of different reasons for that. And if the US had good policymakers and played its cards right, we could have a new boom rivaling the Industrial Revolution. And hopefully we're going to get to that point at some time as we resource lots of industries all along these new FAANGs themes. So those are subjects for another day that we're going to expand on. The first F, fuels. Look, I try not to be partisan, but there's no question that the current administration has deliberately made hash out of the old energy economy. They want to go back now on what they said. Joe Biden wants to go back on what he said he would do when he was running for president. But now, before we even have the green economy of the future off the shelf, and folks, I'm a big supporter of a lot of what the goals are and objectives of this, but you don't destroy the old energy economy first before you're ready with the replacement. And there's been a lot of that. Don't forget, and if you go to my website, there's a commentary about this on there about Janet Yellen. She got her job as Treasury Secretary, not for anything to do with her financial acumen, which leaves a lot to be desired. If you heard her overseas just now, talking about how we're going to bring inflation down and it's public enemy number one and all of this, just claptrap that you're hearing from her. But she got her job because of her climate change fighting bona fides and using the Treasury Department as a cudgel to penalize the banking industry and other investors if they continue to invest money in fossil fuels. They want you to forget about this now that we've started this new energy crisis, but you know, they've done a lot of damage to the old economy. And as I get to it, you're going to see that they've not done a whole heck of a lot of good for the economy of the future that they claim they wanted to build. So we've had all kinds of problems here with this old economy. The biggest story, though, for the balance of 2022, if you want one free investment tip, I just told our folks recently to go much more aggressively long natural gas, the commodity. It is my number one story for the balance of 2022. Moving on, aerospace and defense. You know, we unfortunately see $2 trillion plus this year being spent globally on defense and really on the armaments of war. That's why Donald Trump never got rid of NATO. That's why Joe Biden is prosecuting this proxy war. It's a huge money maker for the military industrial complex, but we've got other things closer to home that we need to be worrying about. One of those things that does go not so much from economic growth and new energy, but it does deal with defense and our ability to supply our own needs are things like rare earths production and that type of thing. Those are investment themes going forward that we need to focus on and look for the opportunities policy-wise and investment-wise to reclaim our own destiny and be able to have the things that we need for avionics, for guidance systems, for all manner of things. A big thing on this too, where we've had promises repeatedly from both Republicans and Democrats and nothing done, is on our infrastructure and on our grid. I'm doing this now from Mark Skousen's Great Freedom Fest conference. My old friend David Tice, his labor of love for the last few years now has been developing this documentary, which we're going to get a screening of tomorrow, Friday evening. And I'll tell you what, this is something you really need to know about. This is another big need that comes into this new FAANGs theme that we're going to do this the easy way or the hard way at some point. So it's a public policy issue and it's an investment issue. Lots of different commodities, lots of different technologies across the whole spectrum feed into aerospace and defense. And these are ones that I cover, of course, for our folks at the National Investor. Agriculture, there's a lot of parts of the world, again, exacerbated by the war in Ukraine, that are starting to have a food crisis. I'll run through these headlines real quick. You've seen and heard a lot about this. But even in a first world nation like Germany, you've now had recent restrictions on how much food you can buy, even of basic things. One box of pasta, one bag of bread flour. And a big cause of that, of course, is fertilizer prices. Even before this Ukraine war, last year, you started to see an increase in the number of farmers in the Eurozone going bankrupt because they can't afford the cost of fertilizer. Of course, a big input for fertilizer is, guess what? Natural gas. So this assisted suicide of the European economy is going to continue rippling throughout the world unless we have a very quick resolution to the situation in Ukraine. And that, unfortunately, does not seem to be in the cards. Nuclear energy, natural gas is my number one theme commodity-wise. Uranium is number two. For many, many years, there's been a secular bull market that is beginning to coalesce. And finally, the world is embracing nuclear energy anew as one of the best ways to have carbon emission-free power 24/7 going forward. And another one of my cartoonist Jerry King's things that he did for me a while ago, I've always made the comment that when you have generalist investors decide, for example, to invest in the gold space, and that's coming sooner rather than later again, it's like a 300-pound man jumping into a kiddie-sized wading pool. When this story gets out more fully, and it really hasn't yet, even though uranium stocks are, despite recent corrections, 4 or 5 times off their lows of a couple of years ago, this is going to be like an elephant jumping into a kiddie wading pool. This is a sector you need to become informed about. As is the case with so many commodities, the bear market for a long time in uranium killed the desire of big companies to invest in projects, of investment banks to invest in projects. So we're going to have a shortage going forward. Cameco, one of the giants in the world, in one of the recent presentations, is very bullish on the future. This is the best ever fundamentals they've ever seen for this space. Last but not least, the Biden administration, and one of the few things they're doing right where energy is concerned, they are looking to buy the first 1 million pounds of uranium and take some additional steps to finally start to augment, or really, I shouldn't say augment, to reinvigorate and revive the domestic industry. We buy millions and millions of pounds a year of uranium. Most of it comes from Russia, Kazakhstan, Canada, places like that. We've got lots of it here and have had virtually no production. So this is one of the many areas where we need to see the U.S. policy-wise take back control of our own destiny. G, the G on the new FAANGs stands for gold and other metals and minerals. Of course, the Fed, along with other central banks, has made hash long-term of the purchasing power of the dollar, although a bigger investment consideration right now is that the exchange value of the dollar is screaming higher in recent weeks against other currencies. And that's the biggest factor of the commodity sell-off recently and the continued angst in the stock markets. It's been one of the few bright spots this year. This chart's a couple of weeks old, so gold is now a bit down for the year, but it's still done better than a lot of other things. Going forward, as far as the broader universe of metals and minerals, look, I said earlier that the Biden administration has done a lot of harm, not only to the old energy economy, but we have battery metals in this country in numerous places where his administration has added hindrances, added roadblocks to the development of these things. Just to give you one example, in the Arrowhead of Minnesota, there are 2 major projects, one of which I've followed for well over 20 years, that has the biggest stores of development ready battery metals, not just in the US, but in all of North America. And the Biden administration has thrown up roadblock after roadblock to the development of these things, and yet they claim they want to have electric vehicles down the road. We aren't remotely close to being able to supply the needs for the number of electric vehicles that this administration and other policymakers have said they want to build. And another thing going forward too, and this is a big public policy thing, you've all heard, I'm sure, that China is disproportionately influential in most raw materials processing, lithium processing, rare earth metals especially. We've got a major problem in this country, and we're in a lot of trouble if we don't quickly realize that we need to stop worrying about what's going on halfway around the world and worry about what's going on in our own country, in our own backyard. And I'm one who is a big believer. You're going to hear more about this from me in the coming weeks and months. We need to dust off and re-embrace a new version of the Monroe Doctrine. let Russia and China and Europe worry about their part of the world, but we cannot have, as is happening again recently, those types of countries coming into South America, for example, and making alliances when we should be the friends to these countries. We should make amends for, in the past, frankly, exploiting a lot of the countries in South America, be partners with them, make sure that we get our resources and our alliances in our own backyard and in our own hemisphere. We're going to be forced into this, so we can do it the easy way or the hard way to be able to make sure that we have all of these different substances that we need for the future. Inevitably, when we get to the end of this current declines and the weakness in stocks and commodities and stuff, the Fed is inevitably going to have to figure out, and policymakers are going to have to figure out how to rebuild and do it properly. Never again will the American public tolerate a Federal Reserve or a government that bails out banks, bails out Wall Street. The things to come in the future are going to have to support people, infrastructure, and everyday life for everyday Americans. Check out this website. I won't take the time to go into all of this, but this is something that is coming. The US is the only major developed country that does not have an infrastructure bank. And again, the easy way or the hard way, we will have one. And these people are out in front in that quest. Quickly, as I finish up on the whole commodities thing, Jeff Curry has been great. He's Goldman Sachs's lead guy and analyst on commodities. This is a very different situation than we've had in the past when we've had commodity price shocks, including from oil. Across the board, there's been underinvestment. The Fed is complicating things now by having this yo-yo because of their monetary policy. High inflation, you levitate all of these bubbles for commodities and so forth. Now they're trying to kill it off. Who is going to invest in that kind of an environment? We're going to be calling on investment banks and big mining companies to invest tens and hundreds of billions of dollars into developing the lithium, the nickel, the cobalt, and all these other resources that are needed. Who wants to do that with this kind of a thing? So there's a reckoning coming, folks, and we need to figure out that we're going to sensibly, with people that understand economics and markets, build this thing, or we've got a lot more pain to go through first. So as I close, a lot of these things are going to be impacted by, does the Fed pull out one too many sticks in its game of monetary Jenga? Do the markets rebel against the Fed, kind of like Boris Karloff did against Colin Clive, his creator, in the initial iconic Frankenstein movie? We don't know. It remains to be seen. But look, even though there's going to be some more pain more than likely to go through with some of these new FAANGs trades, a lot of risk assets, the future is very clear from a public policy standpoint, an investment standpoint, and we better understand this as investors and citizens sooner rather than later. So with that, Dylan, I'll open it up to questions.
We have a couple of questions ready for you. The first one is, did we give Russia any uranium during the Hillary or Clinton years?
Well, there was a very well covered deal where a company called Uranium One was sold out to a Russian controlled company. In the recent past, those assets have been bought back. Those US based assets have been bought back by a company called Uranium Energy Corporation. So they are now repatriated to a US company. And I dare say that it's not going to be too long before, at long last, overdue, we're going to see those assets and that uranium from the US put into service for our own country.
Thank you so much for that answer. Next question we have here is, are there mineral companies that also recycle minerals like SVSW?
There are some like that. There are a number of companies, there's ones that I followed. I promise not to give specific investment advice here because, we're trying to educate people on themes, but I cover a few that are into what we might call green mining, where they find materials. One of them, for example, is able to process ores that have got very heavy arsenic content. That's a problem all over the world. A lot of times gold, for instance, but not just gold, is associated with arsenopyrite as the substance. And a lot of environmental damage has been done over the years, especially by artisanal miners in developing countries, by processing this ore, not taking good care, not using first world standards in how they take care of the waste. So there's companies that can go in there now, one in particular that I cover, that can take that material, separate gold, copper, and that type of thing from it, and render the arsenic essentially a benign product by the US government's own definition, rendered a benign product. So yes, and I look, I do believe, and let me say this just real quick, because we have a few minutes here. I am a big believer that as we build out the green economy of the future, as we look, and that is going to require a lot more still in the way of extractive industries, and a lot of people want to acknowledge, but there are ways to do it better and safer. And yes, there are companies that have got ways to, as part of their mining process, mitigate carbon emissions. They're going to some of the big companies, electric fleets, even hydrogen powered fleets are coming for heavy equipment. There are certain types of ores that naturally will capture carbon. So this can be done. Our shortfall has been policymakers, and again, it's been both parties, just go by the seat of their pants. There's been no far-ranging views at all. There's been no long-range planning at all about how do we get to the future economy, which some of us may not live to see, but where, yes, we still have a growing world population, but we're far more efficient, far more sustainable. And I'll throw this in, the US especially needs to learn this lesson, because we have just under 5% of the world's population, and we consume just about 25% of all of the energy consumed in the world. That's not sustainable. So there are companies that will help to mitigate that, that are part of the new FAANGs team as well.
Thank you so much for that. Building off that new FAANGs team, do you have any ETF recommendations around the commodities sector? And what about managed futures?
Well, I'll tell you that the ETFs I like right now, Dylan, are, UNG is the US Natural Gas Fund. It's a non-leveraged fund. It's just a play on natural gas. We saw natural gas in the US reach nearly $10 an MCF with the overall correction in energy and all the commodities. It came back down, as I showed on that earlier chart, stopped dead on its 200-day moving average, and has now started to rebound even this week with everything else weakening. Look, we've got major shortages in Europe, as I said months ago in talking about all this. In fact, that issue on the green economy and more is still on my page here with the Money Show. You should read that. I said, and this was last fall, that inevitably we are going to see US natural gas prices pulled up toward the far higher prices in Europe. We probably won't reach that, but we're sure not going to see $2 an MCF. And it's astonishing, folks, when you think about this, that it was 2 years ago, or not much more than 2 years ago, there were markets in the Northeast US, some in Texas and Louisiana, whole swaths of Western Canada, where if you produce natural gas, you couldn't give it away. And now we have gone completely in the opposite direction. And this is because of war profiteering and policymakers who have done terrible damage, especially to Americans. We heard from the president recently that we've all got to suck it up, and we're going to have high gas prices and whatnot as far as the eye can see, because that's the price we got to pay for Ukraine. Oh, really? I don't think the average American voted for that, Mr. Biden. And I don't think the average American is going to be really happy when the other shoe drops on this thing. And besides the higher gasoline prices we've been paying for a while, you get to this coming winter and your home heating bill is going to triple if you use natural gas. So wave those Ukraine flags, but it's going to hurt.
We're all feeling it a little bit. And that being said, do you think we are already in a recession? What are your thoughts on that?
It's really weird, because I've had this ongoing friendly argument with several colleagues for a while. There has been very little sign to take one side of that, Dylan, that people are traveling less. I can tell you, driving from my home in St. Augustine, Florida last week through it, across Interstate 10 to Lake City, up through Atlanta, I have never, ever seen the amount of traffic on the road as I did in that stretch. Now, that's not the same all over the country, and keeping in mind, of course, that the Southeast US in relative terms is strong. It's got a growing economy, et cetera. But, people were cooped up for 2+ years. And I think the average household, Joe Sixpack and Sally Soccer Mom said, you know what? I don't care if gas is $105 a gallon now. We're going. We're not putting off our trip anymore. But we're not going to buy this and this and this. We're not going to replace the washer dryer. So what if we need to turn the dryer on for an extra 15 minutes where we used to not have to do it at least after the other 15 minutes to close or dry? So we're going to wait on that. A big investment theme regarding retailers, of course, in the recent past is that they're choking on inventories that they haven't been able to sell for different reasons. So, we've got, it's not an even recession. Technically, we may find out on July the 28th that the second quarter GDP was negative like the first quarter. So technically that's a recession. Whether it's going to get any worse or not depends on just how nuts the Fed gets and trying to undo the damage it did, for the last 18 months before it started to belatedly tighten. But we'll see. But this is going to be a time, folks, when number one, you're going to be forced to be an investor. Long since the passive investing game is over. You can't just close your eyes and buy a basket of stock and bond ETFs and think the Fed has your back. We're not going to see those days for quite a while. And I think as far as the economy is concerned, yeah, we'll technically be in a recession, but it's not going to be a sinking boat takes everything with it. It's the opposite of the other old phrase. There will be pockets of strength. There will be areas where money will flow. And as an investor, let me throw one more thing in here, Dylan. The worst time to invest in the stock market ever was in the fall of 1929. In the ensuing 3.5 years, the Dow Jones average, the major measure in those days, dropped by 89%. But yet 1 out of 3 companies on a New York Stock Exchange were higher during that time. And again, this is a time with the upheavals we've got, many things that are changing for good that we've never lived with before. The end of globalization, the end of the complete dollar hegemony in the world, and the new global currency and commodity wars. We've never lived through this. We've got to tear up a lot of the old playbooks, but it's going to force everybody to be an investor. No more passive stuff.
Thank you so much for that. Building off of that question, isn't that the point, to reduce spending and then bring down the demand for those goods and services?
Well, it is. And uncharacteristically, when we heard so much nonsense out of his mouth for a year or 18 months, when Jerome Powell insisted that inflation would be transitory, don't worry about it. And now we found out that's not true. In relative terms, he's been a lot more forthright recently. And the Fed has made extremely clear that the Fed put, as we used to know it, is gone. And in not too many words beyond this, they do know that they are likely to cause a recession. They do know and acknowledge that the pain in the stock market and the bear market is probably not over yet, because that is how they're gonna do it. And they've come out. Powell in his last meeting after that last 75 basis point hike, I thought was fairly blunt in admitting that, yes, the way that they're going to get inflation down is to whack everybody's pocketbooks and the value of their house and their stock portfolio and all the rest of it. That's how he's going to put inflation back in a bottle. The question is, do we do it in a soft landing or not? And correct me if I'm wrong, folks, I don't think for all the promises of such that we've really ever had a soft landing. The Fed is very likely to overdo things.
Thank you so much for that. And now continuing about the Fed, what are your thoughts for the next meeting? Do you see a 75, 100, or an over 100 basis point hike?
I think if they did anything more than a 75 that everybody has telegraphed, it's going to show panic. It's going to rattle the markets. I think what they're going to do is say 75. And unfortunately for them, though I'm sure they'll be privy to the information, even though it's not released, we're going to learn their verdict on the 27th, 2 weeks from yesterday. 2 weeks from today, we're going to get that second quarter GDP number. And there'll be hell to pay from investors if the Fed continues to act and talk overly hawkish, and they raise rate 75 basis points and leave that or more on the table for September. And yet the next day we're officially, quote, in a recession. So I think that what they're going to do, and I made this quip to my audience recently, I don't think we're going to see the Fed blink still quite yet. They've got to talk and act tough. But even if Jerome Powell doesn't blink, I think you're going to see his eyes quiver just a little bit on the 27th. And the Fed will acknowledge that, yes, we know the incoming data is weaker. We know that there's been a big correction in commodity prices. And so everything is on the table for September. And keep in mind too, that in between you've got the Kansas City Fed sponsored annual picnic out in Wyoming in August. And I think everybody is going to have to get their heads together and figure out, do we really want to let the Fed and the surge in the dollar torpedo the entire global economy? Or is there some face-saving thing we can do to back off at least a little bit? And I think we're going to see the latter. And that could, somewhere between that Fed meeting in July and the fall, that could form the basis for at least an intermediate term bottom for both stocks and commodities.
For both stocks and commodities, that bottom would be really good. So would you then suggest that September, October, when gold is usually a little lower in the year, that would be the best time to invest in this recession?
Well, look, the last time earlier this year when gold was over 2,000 an ounce, I told our folks to sell our trading positions. That was the right call. I did also say that I thought that the worst case would be we would bottom around 1750 an ounce, which is a major long-term chart level. I was not correct about that. We've dropped a bit below that, but I think we're very near the bottom. And what gold investors especially, but others with stocks and commodities more broadly, are going to want to see is the Fed, where the Fed does back off a little bit. It at least acknowledges that, yes, there is some danger that the recession could get out of hand. So we don't need to be in a mad rush and accelerate things beyond what they already did at the last meeting. I mean, it wasn't long before the last meeting that 75 basis points was even on the table. Now they're going to do that in 2 weeks. But I do, again, as I said a second ago, Dylan, I think that they are going to at least talk in such a way to take away fears that they really are going to run us off a cliff. And that
Thank you
will
so
help
much.
gold and other assets.
Looks like I'll be buying gold later this year.
Probably a good move.
And with that, we're going to have to conclude this presentation. Once again, everyone, this is Chris Temple. Check him out at nationalinvestor.com for further resources.
Thanks, folks.
Thank you all again.